Hi there, thanks. So the second session is called New Insights on Taxpayer Behavior. And we're going to have two papers, one by Paolo Di Caro, and the other is Rafael Da Carlo. So with that, I'll turn it over to Paolo after one more reminder that the slides, if you want the slides, they're available online at taxpolicycenter.org. All right, thanks. Over to you, Paolo.
Okay, can you hear me?
Yeah, yes, we can.
Oh, okay, thank you very much. Yes. Okay. Okay. Good morning to everyone, and good afternoon for the European ones like us from Italy. Thank you very much for having invited us to this very interesting conference. This is a pity, no, to be now in the US this year, but let's hope to have another opportunity next year. My presentation basically will try to provide you some of the key issues that we have studied in this joint work with some colleagues at the University of Milan and the University of Insubria. And then if you want, we can discuss more later, or you can send me an email to go deeply into the methodology and all the material that we have in the paper. Okay. Just a moment. Okay. So basically, okay, as you know, there are two main methods, two main approaches to estimate the personal income tax gap. One is the top-down approach, that is the main methodology that is applied in tax administrations, like in Italy at least, where we do not have, as you, random audits, so very good microdata. So another approach, that is the bottom-up approach that I will discuss during my presentation, we require to have microdata, micro information. The key point, at least for Italy, is that, as you know better than me probably, that with top-down methods, you are not able to go deeply into the analysis of some of the key aspects of tax evasion, like the distributional effects, like including tax evasion in the microsimulation models, or finding different profiles of tax evaders. So the key objective here of this work was to think about which kind of methodology could integrate the top-down method that has been used in Italy to provide a new insight to policymakers. What we did was to rescue a 3 decades old idea of Pissarri de Weber, 1989, applied to the UK. The main idea was to compare income and consumption data, so trying to estimate an income consumption curve, like an angle curve, basically, for different categories of taxpayers. Within this estimation, the key assumption is that there are some taxpayers that could not evade taxes, for instance, dependent workers or public employees in the more recent advancements of this methodology, and there are other taxpayers that could evade taxes, like self-employed. So this income consumption method, I just plotted here for giving you an idea, the relationship in our sample between the income, 7 years income data on the x-axis, and on the y-axis you have the log of consumption, food consumption. For the two categories of taxpayers, self-employed, so the red line, and the employee, the yellow one. So the idea is, I will try to convince you, but basically the literature, at the end of my presentation, I will provide you the reference to the main literature, is that once you have this comparison, controlling for different individual and household factors, you should not find any systematical difference in the relationship between consumption and income among categories of taxpayers. If you find some errors, basically, this could be done to underreported income by self-employed. So the main contribution that we did was to apply for the first time in Italy this methodology to estimate self-employed income tax evasion. We had the opportunity, thanks to the availability of data at the Ministry of Economy and Finance, to merge exactly, so by using the personal identification code, the tax returns data, financial property wealth data, and consumption data that comes from the survey on consumption in Italy. We provide different rates of self-employed income tax evasion that can be used for tailoring in a more accurate way audits, for instance. Here I just provide you some ideas on the age, gender, or family characteristics. But for instance, one of the key issues that we found has been to make a distinction within the categories of self-employed. So accountants versus small entrepreneurs, basically. So as you know, these can be different profiles, a different way of tackling the issues of self-employed income tax evasion in this category. Then what we did is to compare our results with the top-down, so the official estimates, and to look at the revenue effects of what we found, and then also look at the distributive aspects of tax evasion. Lastly, what we did also on the methodological side, basically we have updated and we have extended the Decided and Weber methodology by allowing heterogeneous evasion rates within the category of self-employed. Okay, the key point here is that we were able to exactly merge the household budget survey that in Italy, unfortunately, does not report information on income like in other countries, with tax returns data that provide information on declared income. We had the opportunity also of using a panel of tax returns data for the individuals and the households in the household budget survey, so for different years from 2009 to 2016. We also added information on property wealth data and financial wealth data, basically new administrative information that helped us to smooth, to control for additional sources of heterogeneity among the categories of taxpayers. So this is the refinement of the idea of basically the application of the idea of Decided and Weber to Italy, to our sample. So as you can see, basically the two curves should be overlapping, but actually you have the curve, the dashed curve of self-employed taxpayers or self-employed individuals, self-employed taxpayers, that is above that of the wage and salary employees. Interestingly, I will be back in this at the end of my presentation, our evidence is very close to the evidence that has been recently provided for the US and the UK. So we try to quantify this gap and to calculate this gap as tax evasion or income underreporting by self-employed individuals. Okay, I will not go through the methodology, as I said, because I don't not have too much time, basically. So if you want, or then in the question and answer session, we can go deeply, or if someone of the audience is interested, you can just send an email or look at the paper. The key point here is that we have estimated what? We have estimated a consumption income relationship, so a log consumption of food. Why food? The motivation is that food consumption does not depend on the taxpayer characteristics, so basically does not depend on the category of taxpayers investigated here. So controlling for different individual and household characteristics, there should not be a systematic difference in food consumption between employed workers and self-employed. So then one of the key novelty of our work is that we smoothed one of the empirical issues in this literature by using a definition of income that covers 7 years. So basically a sort of a proxy for permanent income rather than current income. So by having different years information on income, we have the log of household income in a sort of permanent way. Then what we also did is to, you add a dummy variable basically to make a discrimination between self-employed and wage and salary workers, but also we were able to discriminate by adding interaction variables for different categories of self-employed, as I said, by investigating, for instance, I will show you some results on household profiles or educational profiles, but then now we are working on adding other, on looking at other different characteristics. Then adding, as usual, a white noise plus additional control factors. So the key parameter in our estimations will be there is the proportional true income that is reported by self-employed households, the key parameters in this literature that has been obtained by using the log likelihood, the log form of this relationship as the formula that you can see in the formula form. So 1 minus the estimated key parameter is the proportion of unreported income that you can assume to be linked to the tax evasion of self-employed. Okay, so I will. This is this table provides you the main results that we have obtained. We ran a series of sensitivity analysis that I will not present here, but are in the paper. So basically, what we did is first to compare the current income versus the average income variable. Because as you know, consumption will not depend just on your annual income, but can depend on your past income, basically. And this can be there can be a systematic difference in these between self-employed and the wage and salary workers. So we found different evasion rates, so 1 minus kappa of income unreported by the self-employed, basically. We used both pre-tax and post-tax family income to incorporate possible behavioral aspects. And in this case, one of the key aspects that you should bear in mind is that the definition of the self-employed households is the household that has at least 50% of income coming from self-employment. In international literature, like that one that I will quote at the end of my presentation for the UK or for the US, the definition was 25%, so half of our definition. We have also checked for the different definition, and when we add those estimates are similar to the US or the UK. Okay, then. The second contribution, as I said, is to be able to find some heterogeneous evasion rates, so income unreported by self-employed for different categories of taxpayers, of self-employed taxpayers. So in this case, for instance, one of the key issues was that single evade more than in couples or than individuals, and low and high educated, there is a sort of relationship, basically, a sort of nonlinear relationship. We have that for low educated and high educated individuals, we have high evasion rates, and in the middle, we have not high evasion rates. We provided some explanations. Basically, what we have is that if you are in couple and possibly you have children, you need to benefit, for some benefits from the state, so you need to declare your income, to be mean tested. And also, as for the educational level, what we have is that at the low education, there are the self-employed more concentrated in some sectors like personal care or agriculture, where the tax evasion rates in Italy are high, and for high educated, they are mostly, at least for Italy, self-employed with an high education, are mostly concentrated in sectors like liberal professionals. Okay, so I will skip the checks that we did, but we ran quite a lot of additional checks because also we published this year, last year, these estimates in the official document of the Italian government on tax evasion, and next year will be a part of the IMF manual some of our results. So we have checked we think quite a lot these our findings. Okay, then what one of the key contribution is to use our micro estimates of evasion rates within a tax benefit micro simulation model, in this case the Euro model, so the European Union tax benefit micro simulation model, the module for Italy, to find the distributional effects of tax evasion in Italy, of self-employed income tax evasion in Italy, and the revenue effects. Okay, as for the revenue effects, interestingly, so basically here what we have is the reported income is the income without the tax evasion. Then we have the true income. So the only difference is at the bottom is the disposable income of evaders is higher than in the absence of evasion. Then you have the evasion adjusted under the hypothesis that all the income that is concealed will be declared, basically. So we have calculated the how reported income will change. So at the bottom of this table, changes in percentage with respect to reported. So basically the third column with respect to the first column of figures. We found that IRPEF is the personal income tax in Italy, so an increase, a rise of about 20% of personal income tax and 40% of social security contribution by self-employed if you switch your self-employed income tax evasion into declared income. We also found that in line with the literature, the evasion rates are concentrated like at the bottom of the income distribution, but as you can imagine, the average tax rate changes more for the wealthy taxpayers. So basically, the top income self-employed save more to evade the declared taxes than without this. So basically what we did is to compare the average tax rates for income deciles under the true hypothesis or the evasion adjusted hypothesis. And also, and this is the last graph, we show you the distributional of the revenue loss in terms of percentage of revenue losses in Italy on the PIT, so the blue bar, and the red bar is the social security contribution. So as you can see, because the self-employed top income distribution have marginal tax rates and average tax rates that are higher, so when they do not declare income, basically they save more than self-employed at the bottom of the distribution. Okay. So as I said, what was the main objective of our work is to integrate the top-down estimates that were the official estimates until the last year in Italy with the new, we hope, robust bottom-up results in line with the international literature. What we have found, as I said, is more or less in line with the UK and the US. So this is confirmed the very recent experimental studies where the Italians are not so different in evading than the Americans or the British ones, basically. What also, in terms of policies, in policy implications, what we did is to provide some evasion rates, different evasion rates to policymakers to operate in a more tailored way. The future evidence of our research is to study the effects on horizontal equity. to adjust our results by taking into account the new COVID-19 shock through the microsimulation model, and to try to update the estimates with different waves of the survey. Thank you for your attention, and if you have questions, as I said, you can email me after or just write today. Thank you very much.
Thank you, Paolo. Now we have Rafael Dacal.
Hi, can you guys hear me?
Yes, I can hear you, Rafael. You're good now. Thanks.
Okay, thank you, thank you. Well, good morning, and thank you everyone for giving me this chance to present this. So here we go. So a quick disclaimer before I start actually going over this. This paper was actually based on my dissertation. I just made a quick synopsis of what I had to make it quick and more readable, let's put it that way. And so while I do work for the Internal Revenue Service, all the work that was done here is actually using data that is available or from this particular research, so it's not internal to the IRS. I do have to give another little tidbit of information. I have worked on this particular topic within the IRS on several projects internally. So there is a little bit of insider information. It's just not disclosed in this paper. And some of the individuals, one of which is here today, was part of my committee, and that would be Alex Turk. So thank you to him. And with that, I start. So a quick little background, it has to deal with federal tax deposits. A federal tax deposit is deposits that are withheld for income for both employers and employees for Social Security and Medicare. And so the idea is that once you work, your employer withholds some of your taxes, and then they're supposed to do some sort of deposits. Those deposits are generally scheduled either monthly or semi-weekly, depending on your particular organization. And so there are some criteria for that. And then the other important thing that is important with FTD is that you have an FTD alert program, which is in essence kind of like an early detection program that basically alerts the IRS that this individual might be falling behind in those federal tax deposits. The next item is the idea of a safe harbor, which it's nothing more than a legal provision to reduce or eliminate the liability of certain taxpayers based on whether or not they have met some conditions that will qualify them for it. Then we get into what the research question was for this particular project was, and is does different tax regimens such as a safe harbor, would implementing such a safe harbor provision change the behavior of small businesses or self-employed taxpayers with respect to their employment tax? And so one of them is that, hey, you got to be compliant, but then I'm happy you're compliant. The next thing is, are you actually making the payment? And so then we get into the actual scope and kind of the implication behind this. And one of the things is, hey, if this particular regimen works, can we improve the compliance? And if you can improve that compliance by reducing misreporting and underpayment, hey, there's a caveat at the end of the end, which is you can reduce that tax gap, which according to the statistics is about $72 billion that are associated with employment tax. And so that's kind of the practical implication and why a lot of the work I've done on this has been on reducing that employment tax gap, I'm sorry. A lot of people have talked, so I've just mentioned that, you know, we kind of fall somewhere between reporting and payment compliant and employment tax, which is usually known as trust. And so the main thing that we have to focus is in that employment tax, which is basically defined at Publication 15, which kind of tells you what is the penalty and who are the authorized individuals. The other thing I looked at is what is considered to be the payroll tax dilemma, which kind of it works in the way that if an individual is falling behind in some sort of liability that they might have at their work, they might use this federal tax deposit withholdings almost as a short-term loan. The problem with that is that the penalties on that short-term loan is 100%. So it's not necessarily a very good idea. And so the way we framed this particular research was similar to the very first one that was stated, which is the general deterrence theory, because you have the celerity, severity, and certainty, and we're able to identify what that severity is because the Publication 15 gives it to you. But what we're trying to do is kind of adjust that certainty based on whether or not you volunteered on the safe harbor provision. And then last but not least is an income shock. At the very end, we decided to put an income shock, which is a supply shock that basically show that they're having issues in terms of income revenue to see whether or not their payment compliance will remain. All right. So we get into the actual model, and this is kind of like a quick visual of what we were trying to do. And it's kind of based, again, on the simple model of rational crime. So to simplify it is basically you have this equation and you have some expected utility, and that utility has two sides. On one side, you have the pros of cheating, in essence, and not to say cheating the way the other person says, but not purposely not paying your employment tax. And then you have the cost of getting caught for not paying your employment tax. And so basically what we're trying to do is that if you, particular individual decides to be in that safe harbor, you're kind of eliminating the right side of that part of the function, which basically eliminates all the penalties. However, you kind of have to agree to make the payments on that employment tax. Ideally, it will be something similar to a direct deposit that comes out of a particular business account. All right. And so we kind of set out to determine 4 hypotheses. Some of them were just to determine whether or not the model is kind of working. And one of them was, hey, we put individuals in a tax liability threshold randomly. Hey, does that tax liability threshold have some sort of implication once the individual's in a safe harbor provision? And then hypothesis 2 is kind of divided into 2. So if the individual who experience an audit, will they have higher subscriptions later on with the safe harbor, and will they be more compliant? And then the next 2 is hypothesis 3 is to individuals who choose a safe harbor, will they be more compliant with respect to payment? And again, most of the literature is on filing and reporting. We were mainly focused on the payment because a lot of the FTD has to deal with the actual payment. Then we get into hypothesis number 4, which is, hey, now we introduce that income shock, will they stay compliant? All right. So the general experiment had 4 phases, and the idea is one was to phase people into the actual, experiment. The other ones were to introduce whether or not introduce the safe harbor and then audits and eventually the shock. So that was kind of the idea behind it. And this was an online experiment, and the sample size was of 215 individuals, 8 of which was a pretest to make sure that the actual experiment was working. So then the probability of detection was kind of based on publication, publication 15, but also based on some of the information from the IRS into what those audits are. And so then the population of interest was basically small business because that's the area that I work for within the IRS. All right, and this kind of gives, again, a visual description of what this experiment looked like. So we had the random assignment to the high and low liability thresholds, and then you had the next round, which was the introduction of the enforcement. Then we introduced the safe harbor and then the income shock. So hopefully that the visualization provides some better idea. The methods, so we try to assess risk attitudes and things of that nature, and we also try to determine whether there was a change in the perception of audits and penalties, just to make sure, and mainly because later on we would determine or see the interactions between those assets, assessments of risk, appetite, and the knowledge of individuals later on as far as our logistic regressions. And then just to see if there was any change, we did non-parametric and ANOVA testing. So the first thing what we found is with respect to the perception and risk construct is that there was statistically significant changes with respect to perception. And we also found that the risk constructs were reliable and valid, so we basically were able to use them later on in logistics regression. And so now we get into the actual findings on each of the hypotheses. So what we found here, we had somewhat of a mixed results as to whether or not individuals with higher tax liability thresholds will have lower subscription to a safe harbor. So in general, once you get to round 5, you did have higher liability threshold. This showed lower subscription rate than those with lower. But with respect to round 4 or 6, we did not see a statistical difference. And now we get into the hypothesis number 2, which again is divided into 2 subsections. So the first one is the individuals who experience audits will have higher subscription rates to a safe harbor provision than those who do not experience an audit. And what we see is that there was a statistical difference. So that was a good thing. And then on the second part, individuals who experience audits with higher payment compliance rate, which is really what we were looking for, we didn't find anything. There was no statistical difference there. And then we dig a little deeper, which is on hypothesis number 3. Do individuals who choose the safe harbor, would they be more compliant with respect to payment? And again, because that was our main focus here, that's what the FTD alert is focused on. And again, we did not get the results we were hoping for. And the fourth hypothesis, hey, if they have this income shock, will they be able to see some improvement in the payment? And again, we didn't see it. So this was not a very happy moment. However, we did notice as we looked into it that there was an increase in the payment compliance as you look at it. And so what's going on here, it seems to be that there's a problem with respect of, there has to be some sort of interaction. So we then went ahead and started looking around using the logistic regressions as to determine, okay, what's going on? Because there's obviously an improvement in compliance, at least on rounds 4 and 5, and what's determining this compliance improvement, even though we don't see it based on the ANOVA testing and the non-parametric. So then, and this is just one of the findings. There were several of them, but we went ahead and we started looking to see, hey, what happens with respect to the compliance of individuals? And what happens is that there was an interaction with prior enforcement encounters and the ability of the safe harbor to improve people's payment compliance and compliance in general. The problem was that you basically had to have some sort of interaction. And so we were able to have higher payment compliance once we start adjusting for certain risk behaviors. And that's the general findings that we found throughout some of the logistics regressions that we had. Ooh, I think I pressed the, oh, okay. Great. So in general, we weren't able to say, hey, our hypotheses were 100% accepted, but in general, we were able to find some insight as to whether or not the payment compliance and compliance in general would be improved if you have a particular regimen such as a safe harbor for individuals. So the general takeaway then becomes, hey, this particular regimen might be useful for the IRS in terms of having better compliance with respect to employment tax. And so there are some limitations to this research, obviously. There is some design bias. I think Janet was the one that mentioned it earlier, and well aware of that. There was some issues with respect to the payment of the participants. We would have liked to be a little bit more realistic, where if you get punished, you get paid differently than those that did not. And given that we really didn't have an ability to randomly select individuals from the population, that makes it harder to have that inference to the population. So all the results we provide here basically result from those individuals who participated in this particular research instead of the population as a whole. So one of the ideas behind this, or at least the next steps, was based on the work I was doing internally in the IRS, which is, hey, maybe something similar to this could be implemented as a pilot within the IRS. And having this particular tool, we could then have a control group, and then we still have the population, which allows us to infer whether or not something like this will be beneficial for the IRS in terms of payment compliance. And with that, I yield the floor back.
All right, discussing these two papers, we have Jamie McGuire. So hand it over to you, Jamie.
Hi, hope you can hear me. I'm Jamie McGuire. I'm a senior economist at the Joint Committee on Taxation. I'm actually on the staff of the Joint Committee. The Joint Committee is composed of 10 members of Congress, and so there's a disclaimer that what I say should not be construed to represent the views of those members. Let's see. There we go. Okay, first I'll discuss Paolo's paper on Italian tax evasion. So I really liked, a lot of things about this paper. One of them was the sort of simplicity of these. You start out with plausible assumptions, and not that many of them, to measure the evasion among the self-employed. So there's taxpayers earning income that's reported by third parties generally have to be compliant. The Italian tax authority knows about the income, so there's limited ability to evade, whereas self-employed, of course, have a lot more flexibility with how much income they report. And then the idea that both groups report food expenditure correctly, pretty sensible. Although, we'll revisit these assumptions a little bit later. And then finally, that food expenditure does not depend on whether you're self-employed or have like a wage or salary job. The other thing I really like about this paper is when early on you see a chart or figure that just sort of shows you there's something there, and it's nice and simple. And in this case, this is a little different from the one presented in Paolo's slides. I copied this from the paper. But we can see that the food expenditure of self-employed households is higher for any given level of income reported to the tax authority than food expenditure is for third-party reported income households. Well, we had that assumption. If food expenditure doesn't depend on the type of income that you have, seems like there's something going on with how much income is being reported, and specifically, these curves should be, per the assumption, identical. So it strongly suggests that self-employed households are underreporting their income. It's interesting at the top, at the far right side of the figure, that they overlap, suggesting maybe that self-employed households with the highest income reported to the tax authority are not underreporting. It kind of almost mechanically makes sense, perhaps, as we'll discuss later and as Paolo discussed, when you re-rank based on true income probably that gap might be even wider than for lower incomes. So I guess the main result of the paper is the estimated size of the sort of underreporting or tax gap for self-employed households. The paper finds that it's around 40% relative to the amount, relative to the reporting by households receiving third-party income. Those households may have some non-compliance, probably very small, but so 40% larger for self-employed households. One thing that, so I was I'm familiar with the IRS tax gap, the NRP, and I was trying to put these numbers kind of in context. And they seem kind of low based on the tax gap numbers, but then I realized that that 40% is really a weighted average of the underreporting of both types of income combined, because of looking in the appendix tables, I think I calculated correctly that 93% of the self-employed households also earn third-party income, third-party reported income. So consider a simple example. Take a household with 100 in income, 80 of which is self-employment income, so 20 is reported by third parties. That 20 is going to be reported accurately to the tax authority. So then of that remaining 80 of the self-employment income, suppose the total reported income is 60, meaning that 40 out of the 80 of self-employment income is unreported. So here we see for the household, measured at the household level, we have 40% underreporting. But if we measure by sort of the line item, the self-employed income is underreported by 50%. So then I wanted to put it in context. This is a busy slide, but looking at comparing to the US NRP, there's sort of two lines that seem most comparable to the results in the paper. The items subject to little or no information reporting, and also the just non-farm sole prop income. And those, we have a net misreporting percentage of like 55 or 56%. Another thing to put in context is, so I think Paolo said, or maybe it was the paper that said, that this evasion by self-employed households represented or was of magnitude equal to 17% of individual income taxes paid. And in the US case, it appears to be, if you take that 109 billion out of the slightly over $1 trillion in individual income taxes paid, the figure for the US compared to that 17% is 10%. Paolo mentioned a US study that found lower misreporting, around 30% or so, but that was based on the self-employed households being defined as, I think, getting 25%, at least 25% of their income from self-employment. And I think that the reference is Hurst et al., 2014. Took a look at that paper. It's actually measuring US income misreporting in survey data, which is sort of interesting. I hadn't seen that paper before, but it suggests that, so even if of course people have this incentive to misreport their taxes to the tax authority, but they also apparently, Hearst found, misreport on surveys by, around 30%. So anyway, that was sort of learn something there. So Paolo had some really nice results on heterogeneity. First one being that single individuals underreported more. Single self-employed individuals underreported more than self-employed households that were couples. And I was kind of curious if it were possible to drill down a little bit more on this. Specifically going back to my slide 2 slides ago, I think it was, if the underreporting could be measured by the type of income, so the line item, rather than by the household type, we might be able to learn more about what's driving the effect. It could be just mechanically that if you have a couple, one of them might have a salaried job and therefore be more likely to have third-party reported income. So possibly the line item might be identical in terms of on the actual self-employment income might be unreported at the same rate. But Paolo also mentions various other possibilities, like needing to get benefits, he mentioned in the talk today, but also risk aversion, coordination between the members of the couple, possibly some other reasons. So it'd be interesting to see whether it's sort of a real effect or whether it's an effect based on the sort of the level at which it was measured, the household level versus the line item measure. Powell also found that tax evasion was highest for the most educated, but also the least educated. And I think you just mentioned just now that maybe it could have something to do with the types of jobs that people tend to have. But it's kind of interesting that it's nonlinear. I'd be interested to learn more about why that is. So back to the distribution, we looked at that figure earlier at the beginning of the talk, that for any given level of reported income to the tax authority, well, actually, we didn't see that right there, but in the paper, it shows that self-employed households have a lower average reported income, but a higher average true income, apparently, based on their higher food consumption. So underreporting skewing toward higher income households. And so I guess, as I mentioned, it's slightly counterintuitive based on that figure, which suggested more underreporting for the lower reported income, but that's sort of just reinforces the importance of re-ranking people based on true income, like in the US that John Slumrod paper did, and this paper does as well. And then, of course, if most of the tax non-compliance is for higher income households, progressive tax system also means that those higher income households, because they have a higher tax rate, they're benefiting all the more from any given level of income being unreported. So I'd like to revisit the assumptions briefly before turning to Raphael's paper. So there's this assumption that all groups report their food expenditure correctly. Well, we know that some people lie on surveys. Maybe they're concerned about somehow getting caught if they knew that the data was going to be linked up by researchers or something like that, or maybe it would get out to people actually involved in enforcement. So is it possible that tax evaders underreport to avoid food expenditures to avoid detection? I don't know. And so this, if that were the case, then that would imply actually larger evasion than the paper finds. And then the other question is whether food expenditure depends on the type of income or not. I could see it going, both ways. It seems like a pretty reasonable assumption, but it may be that, if people self-employed people work from home more, they might dine out less, have lower food expenditures, but there could be reasons why they have higher food expenditures. Given that I have about 4 or 5 minutes left, I'm going to turn now to Raphael's paper. So we looked at a tax gap chart earlier. That tax gap chart was on the individual income tax underreporting rates. Now we're going to kind of scale, pull back and look at the tax gap in the US as a whole. And what we're especially concerned about in Raphael's paper is employment tax noncompliance. And this, $81 billion tax gap for the tax year 2011 to 2013 numbers, or 69 billion in underreporting. Now, there's 2 really big components, which are the self-employment tax noncompliance, and that's more just tied to the sole prop noncompliance. If you underreport on your individual income tax, your self-employment income, then you're going to underreport your SICA as well. Raphael's paper seems to be more focused on FICA, but there's still a pretty significant gap there, and underreporting of 24 billion per year. So moving to Raphael's experiment, the participants were authorized individuals from small firms. I thought that was pretty cool. We're now taking individuals as our participants that that are kind of understand the situation, sort of, and so maybe we're getting a better measure, possibly better external validity that way. So I thought that was nice. And the roughly experimental setup that Raphael described, participants were asked to voluntarily report and pay employment taxes over 6 stages. They were either assigned a high or low tax liability. Starting in stage 3, they could choose to opt in or not to a safe harbor. And then in stage 6, they had to respond to an income shock, and there was random audits and a penalty for noncompliance if detected. So moving to Raphael's hypotheses. So the first one was that taxpayers with higher tax rates will be less likely to choose a safe harbor. And I'm guessing that's, so I guess what I'd really like to know more about in maybe a future version of the paper, or maybe Raphael can tell us about it, is a little bit more about the structure of the safe harbor. I'm guessing that it must have been more expensive to choose a safe harbor given a higher tax rate, and that could be why they'd be less likely to choose it. The taxpayers experiencing enforcement will have higher likelihood of choosing safe harbor and higher compliance rates. That was the second hypothesis. That seems like probably because enforcement would become more salient if you experience it, but also it could just be some updating of beliefs, like maybe enforcement seems more likely than you expected or more expensive than you expected previously. There's a question about whether maybe taxpayers who choose a safe harbor will be more compliant, could be correlated with a desire to comply. You're sort of opting in, you're saying, I'm going to comply, so yeah, it sort of makes sense. And then perhaps choosing the safe harbor might put you in kind of a mode of like feeling like you're going to comply, or maybe even sort of a pre-commitment, so that when the income shock happens later, then maybe you remain compliant. So I mentioned briefly that I'd like to know more about how this particular safe harbor is structured. There's not a lot that I was able to find in terms of a literature in safe harbors. I guess generally they make things simpler so they can reduce errors or increase compliance, but they also sort of define a minimum that you need to pay or do to comply. So safe harbors could result in less tax paid. And then I was a little concerned about the incentives, how the taxpayers or the participants rather, were all paid a flat rate rather than being paid on their choices. So it's not quite clear what was driving the participants to make the choices they did. The fact that they are authorized individuals is reassuring a bit, like they have some real world experience, so it might mitigate that to some extent. I'm curious what the participants knew. Did they know they wouldn't be paid? And I'm also kind of curious why the IRB constraints didn't allow payment based on choices, since it's a standard in economics experiments. So overall, I'd love more detail on how the experiment worked, what exactly the participants saw, what were they asked to input, and then finally, what really makes the experiment about employment tax as opposed to being a stage game where basically people are just taxpayers choosing to comply or not. So I'd love to know more about all that. I think it'd be really cool if the IRS could build on this work and do some pilots, as Raphael mentioned. All right, I will turn it back over to Brett. Thank you.
Thanks, Jamie. So if you have questions, you can use the Q&A function in Zoom here to submit them, and then I'll read them out. But in the meantime, I'd like to give Paolo and Raphael a chance to respond to Jamie's comments. So maybe Paolo, you can speak first if you have anything to say after Jamie's comments.
Okay. Thank you very much, Jamie, for a very interesting reading of our work and very interesting observations. So basically, I got three main suggestions from your presentation. First one was about the strange curve at the top. The very interesting point is that in the US is the same. If you look at as I said, the work of Hurst, then in the published version they have dropped, but it's the same. So probably this needs further investigation on why the top level, there is a sort of decreasing that is in line with the literature, on the, as you said, for high income taxpayers, possibly the best option is to elude taxes, or not to evade taxes, so to squeeze income, but not to evade directly taxes. So this is the first observation. What I have not probably clarified during the presentation, but I hope it's quite clear in the paper, is that we make a distinction between the evasion rates that they refer to the income under reporting. So in this case, evasion rates we find that are decreasing more or less with the income distribution. And then what we find in terms of evasion of personal income tax. So as you have interestingly pointed out, that the progressive tax system, it gives you that the highest losses are at the top of the income distribution, even if the evasion rates are lower for the top income distribution. About the observation on the reporting consumption, and also I saw that there was a Q&A question. My first answer to you is that basically what we did, luckily we have more or less 55 items, and we can distinguish between the consumption of food at home, in restaurants, and so on. Because, for instance, in Italy, self-employed, they can deduct from the income part of their like representative expenditures, basically. So what we did is to run some sensitivity analysis and then to reduce to the food expenditures, for instance, at home or shops or supermarkets and so on, to make this more comparable as possible between taxpayer categories. The second, and then I mute myself, and also I hope to answer to them, to one of the audience, basically that we are in this literature, there are different kinds of consumption items that you can compare. Home utilities, health expenditures, and we also tried to run, but the exclusion restrictions, so a priori, we found differences between the taxpayers' categories. So this violated the key assumption, no? That apart from income, consumption should be the same, for the taxpayer category. So we are quite aware that our food items, as I say, controlling for the different meaning of food items, will work quite well. And the very last point, yes, we are very interested to modeling, if you have suggested, to modeling why some taxpayers are more evaders than others. As I said, for instance, in a recent, we also find differences across territories or across jobs, across self-employed sectors of activities. But we will investigate this further, probably by looking at individuals rather than households. I hope that I have answered your question, observations.
All right, thanks, Paolo. Rafael, did you have any response to Jamie's comments? I think we maybe can't hear you right now, Rafael, if you're speaking. Something happened with your audio.
Can you hear me right now?
Yeah, now it's better. Yeah.
All right, cool beans. All right, so it was, I'll start first, I guess, backwards up from some of the comments that Jamie made. And so based on the IRB and the flat rate, I have to admit there was some path of least resistance. The IRB did provide some issues having that. And I just said, okay, I'll do whatever you want. So I plead guilty on that one. But it is definitely true, when in an ideal world, we definitely would have wanted to pay differently. And I know one of the authors here, James Alms, was at Georgia State, and he's done research like that. I don't know why they were so gung-ho with mine that they wouldn't let me. But I just said, okay, whatever you say. So there's definitely some issues with that. With respect to the pilot, that would be an ideal thing, because then we will be able to control for it and have population data within the IRS. So I have reached out, because I kind of stopped doing work on employment tax, but I did reach out to the actual program manager and tell them, hey, this might be something you might want to further research. I don't know if they've taken it up or not. So with respect to choosing safe harbor, the simplest example I could make of how this would work is almost like a direct deposit that a company can withdraw from your bank account. So you set it up, based on those publications 15. So if you're a company X that has to do it bi-weekly, then the IRS just goes in there and automatically withdraw some estimated amount of what you should be paying. And if it's on the monthly one, then same difference. You would get deducted at, I don't know, the 15th day of the month or whatever it may be. So that's probably the best example in terms of the payment compliance. In terms of the filing compliance, it would be almost like a system where they would automatically submit their forms. So that would be the idea in terms of how the safe harbor would work. With respect to desire to comply, I think that one is a desire to comply. Another thing has to do with that bias, whether since tax is one of those things people tend to not be fully upfront about what they do. It might be that also. There might be some, I don't know what word to use, but they're not as upfront and clear as to what they're doing and why they're doing it. The other thing is it's a lot easier to comply on this voluntary system, because then once you comply, you really don't have to worry too much other than just filing. The rest will be done automatically. So some of it is, and this goes to some of the IT research that I stumble into it was just ease of use. If it's something that you could do easily and never touch again, then it makes it a lot easier for you to stick with it. So that might help with that desire to comply. But some of the logistics regressions that we ran did show that, hey, if you're risk adverse or not risk, or risk loving, will lead to some of that desire to comply. And so those are some of the issues that we did look at and try to see, or at least aware of items that the IRS is doing.
All right, thanks, Rafael. I'm not seeing any other questions. If anyone does have any, just up there in the Q&A tab. I had a little bit more question about the safe harbors too, actually, because it seems to me like the safe harbors could be like sort of more or less generous, right? Like there's not one type of safe harbor, right? So I'm curious if there's any variations of that you might have considered in the experiment, or if it was just kind of a one type that everyone was offered. Oh, Rafael, we can't hear you again. You're muted.
Okay. Can you hear me now?
Yeah, there you go. You're back.
Okay. No, we use plainly just one size fits all type of French vanilla safe harbor. I am sure that you could set it up. In a pilot, I'm sure you could have different types just to see if they have different results. But I am, we just use one type and one type only.
Right. Maybe I have a question maybe for Paolo as well. Your study is mostly focused on underreporting of receipts. But there's this other side of expenses that comes up in terms of non-compliance for self-employed taxpayers. So they can decrease their tax not only by saying they make less income, but also saying that they have more expenses that they actually do, and thereby increase their deductions and reduce their tax bills. I'm wondering if that expenses angle factors into your work in any way, or if you're planning to look at that side. I know you kind of mentioned maybe there's some issues with the assumptions with the way that the data is, but yeah, I was just curious if you thought about that angle.
Okay, thank you, Brett. Yes, of course, because we look at the reporting of income, but of course you can have some under declaration, so basically I am declaring what the key point here is that I think we rule out these because we also consider pre-tax income. So basically in Italy, what you have that there is like the gross income, that you declare. Then you have the deductible items, and then you have the net income. The net income, I mean the taxable income. Then you have also on this income you have the calculation on the taxes basically, and then you have the disposable income or post-tax. I think, yes, we rule out your concern by using the gross income. So basically, we also use just before adding the taxes or deductible items and so on. So for this reason, I think we can rule out these. Just adding one point to Jamie's suggestion on the 15% of households and the threshold. So basically, we selected for us the self-employed are dummy variables. So once you have the 50% of your income coming from self-employment, so for instance, your wife is a dependent worker, so you're the husband or vice versa, no? And but your income is 50%. We select that household as self-employed households. So then we use these in the, so I think at least in the evasion rates, we have not the issues that you have raised. The issues that you have mentioned, they can be possible when we calculate the amount of evaded taxes, because we pick those households as self-employed. We try to smooth these when we reweight in the tax benefit microsimulation model the type of households and the household income. So I think we ruled out also these, but I should ask to the microsimulators co-authors. If you want, I can answer by mail. Thank you.
Thanks. Maybe I have one more for you, Raphael. You mentioned small business owners who fall into this payroll tax dilemma, where they're basically, they don't have enough cash flow, and so they borrow from the withheld taxes that they're supposed to be paying to the government. I was wondering if there's a way that we have, or the IRS has, to identify businesses that might be having this problem. You know, I mean, we can see if they're not paying the taxes, right? But can we tell if it's because of a cash flow issue somehow?
So I know this will be outside of the paper itself, but I know that from some of the profilings that we did, I don't know, the last 10 years that I was involved, I don't recall ever seeing anything as to whether or not we know that they're having some sort of cash flow problems. So for example, right now you have a supply shock with COVID. That would be something that you could identify and say, hey, right now you may have some issues that with respect to their supply shock. So you know they're going to have lower revenues. What's going to happen? Are they going to use this as a loan? I don't recall ever seeing anything of that type of information, at least not internally, and definitely not in the experiment.
Yeah. All right, well, I don't see any other questions here, so maybe we break a few minutes early. We're going to take like a 10-15 minute break or so and start back at 12:30 Eastern time for the keynote speaker, Charles Rosati. And I'd just like to thank Paolo, Raphael, and Jamie, and all the attendees for having a great panel now. Thanks. See you back at 12:30 Eastern time.
Thank you and have a great day.
Thank you.